Hi, everyone, and welcome you to the podcast Value Investing Talks, where we speak about different investment approaches and meet with different people from different industries and speaking about the investing, investment styles, and finance, business, and life in general. And today, my guest is the great guy, Harry, who is the fantastic guy in terms of the finance and have great ideas and knowledge. And we will speak today about his journey, about his ideas in investing, and also about his book as well. So, hi, Harry. Nice to meet you.
Hi. Thanks for having me. I'm humbled by the introduction that you gave me. Yeah, so just to elaborate, I guess more about myself would just be that. So I'm a 17-year-old now, and I got really interested into value investing around 4 or 5 years ago during COVID, and then through that I first started with a blog, and then right after that, I people recommended me to write a book, and then so this was the I'm not sure if you can see, but this is my book and it's the cover. And I think the whole writing process was fantastic. It took me around 2 to 3 years to compile it. And the book basically focuses on aggregating insights from top investors and their mental models, their valuation methods, their thought processes, how they look at business, etc., psychological tendencies that they take into account and stuff like that. And I also run my podcast where I discuss more in detail with guests and other people that I invite that I haven't specifically talked about in my book. And everything from my book goes to charity Dakshina Foundation, which I'm sure a lot of people would know that Monish Pabrai runs. And
Yeah.
that's so far, that's me.
Yeah. That's actually fantastic because I remember myself in the 17, 18 years old when I just understood and trying to understand where I wanted to start. I started with the businesses, with the startups, but you actually went further and already started with a great foundation. And my question was, and actually is, how have you come up to this thing? Because not all people in your age actually start with investing, actually think about investing or business in general. So it's very rare to see that.
Yeah, I get that question a lot. And
Yeah.
so basically, what brought me into value investing was that I remember in COVID, my parents were having a discussion on the dinner table on stocks. And at that time, I had heard a lot about stocks in general. And both my parents, they aren't in finance or investing and stuff, but I guess they were just talking about it like normal people do. And it was on the stock market crash right after COVID and all the uncertainty that was there at that point in time. And so I asked them out of curiosity what a stock is. And at that point, I didn't know anything about all of this. And it was just, I was purely curious as to what investing is, what a stock is, and stuff like that, and why does it matter so much. And then after on, my parents tried to explain it to me, but I didn't really get a good answer, and I wasn't really convinced by why it matters so much and what the stock market is, how does it work, and I just kept on probing them more and more. And after a certain point, I think they couldn't answer my questions anymore. So my dad recommended, or rather, his friend had recommended him a book earlier. And so my dad recommended me to read it, which was One Upon Wall Street by Peter Lynch. So I
Yeah.
read One Upon Wall Street, and then I found it very interesting, and I got even more fascinated by investing in stocks and stuff. And then I just went further into the rabbit hole. I read more and more books, and then read more and more blogs. I started writing my thoughts down, met people online where I met you as well,
Yeah.
through the value investing groups. And then basically just got really interested to it. So it was, I guess, by luck that I found this passion and that I really enjoyed value investing.
Yeah, that's really fantastic. I think a lot of people just find themselves, including the passion in the finance and investing during the COVID and all this time when you have a lot of resources and a lot of free time in general to understand and rethink about their life and the whole strategy. And personally, I started looking through investment in 2018-19 when I just found the book by Warren Buffett, his annual letters to shareholders by chance. And at that time, I already had a couple of companies and I sold one of them. And I was thinking how to work with that and what should I do next? So what's the next step? And at that time, it was like the situation as you. So basically you found something which was really interesting and caught your attention, and you completely goes there 100% and try to read, understand everything which you can, and read more and more in terms of how to educate yourself more. And yeah, it was a really interesting experience, and I really understand you. It's really great that you started at such a young age, because we all know from the value investors guru that it's great to have the long run rate. And basically, this comes to the specific strategies, because obviously there are a lot of value investors who both you and I are looking at, and they have different strategies and understanding of how to properly analyze the company or how to look at the market or some specific firms in specific sectors in specific geographies. And my question here to you, after reading and understanding and gaining this experience, both for writing the book and analyzing the portfolio and companies, have you noticed any specific points in the strategies which you apply to yourself as well? Or you maybe already created some specific patterns and specific strategies for you, which you try to utilize in your work, in your analysis, or in your life in general?
Yeah, so firstly, I think in the whole process of writing the book, I learned a lot more than I would have if I didn't start on it.
Yeah.
And so after that, my strategy actually evolved much more. When I started early on, it wasn't really looking at the right stuff. It was more of speculation, I would guess, and I thought it was investing, but it wasn't. And then after the book and after studying so many great individuals, I think I kind of developed my own, or rather, I would say I took some from here and there. And I would say it's pretty much similar things. I think, again, like for each business, it depends on, I mean, every business you look at it differently, and there are different things to look at. And then I think for me, I see two general patterns of investing or ways that I look at companies. And one of them is, which I've gotten interested into more recently, is this more of this liquidation value type of investing, where you've got maybe a mediocre enterprise, or you've got an arbitrage opportunity somewhere, or you've got some sort of other, a discount to intrinsic value, assets that are hidden, etc., etc. And then you basically look at the balance sheet and you try to find the bargain. And this is very much Graham-ish type.
Yeah.
And it is, I mean, I would say it is a smaller part of what my main investment philosophy is, but it is a good place to park your money. And I think Buffett did that a lot in his starting of his career as well, where when he really couldn't find any opportunities, he would keep them in these kind of companies, or he would put them in these places for his money to grow.
Yeah.
And then the main investing framework that I have is this idea, of course, Munger Buffett idea of buying great companies at great prices. And great companies you find through reading annual reports, through reading, I think, industry magazines and trade magazines and stuff like that. And most of the time, all these companies that I buy are usually when there is some macroeconomic issue going on, or when there is a specific event with a company that makes it seem cheap, or something goes wrong, an earnings miss, etc., or huge problem comes into the company, or there's a management change or stuff like that. And in these places, of course, great companies have great moats, large moats with sharks in it. And what I recently found really interesting was, of course, this is from reading a lot of Buffett and Munger, is that you want to find companies that have very strong franchise value. So that have the ability to generate very high returns on capital, returns on equity, etc. And then to generate that even more as they grow. So as they grow, they require little capex to continue growing, and you can redeploy everything into the business and it will just grow tremendously and earn the same amount of returns that it did when it was smaller in the previous year. And this is very hard to find, actually. Very few businesses will be able to do such wonders with the amount of money that they have. And I think most growth tends to be disruptive in a way, in that sense that it destroys a lot of value in the business, because you may grow your earnings 20%, or you may grow your revenue 20%, but proportionately your capital expenditures will start increasing, and then your other, your working capital requirements will start increasing and things like that.
Yeah.
And so then your margins start getting lower, and then your returns start getting lower, and you need just a much larger chunk of money to be able to generate that same amount of return. And so that is not the type of businesses you want to look at. And generally you find great businesses in niches and in areas that people don't look at, small monopolies that are hiding somewhere, or just that have a great advantage somewhere and people have yet to discover them. And they usually aren't very massive. If you look at, of course, the really big companies, and they're all pretty fantastic companies, but to really get a bargain in those areas is very difficult, because there are hundreds of analysts tracking those companies, and everybody's looking at them, and everybody knows exactly what's going to happen 5 years from now. Everybody's got an earnings forecast on them and things like that. So then it becomes very hard for you to find a bargain. And so that is most people tend to get drawn towards bigger companies, of course, because it's more safe and it's easier to invest in them. But I think that is where you rarely find bargains. You can find them, but it's hard for you to find them there. And so great. So in figuring out these type of companies, I think you look at really good amounts of owners' earnings and profitability and all these things, that they will basically come out to you, and you will see very clearly that these are not average, or these are not standard earnings or margins or things like that. And even in annual reports, you can judge by the tone of management, and in earnings calls by the tone of management and things like that. It's very easy to differentiate between what's, written by a PR company or written by the company's PR group, and what's written by the CEO themselves. So those kind of things really stand out, and those things really make it much better to buy a company than it was. For example, for Disney, for example, back 2, 3, 4 years from now, it had a lot of problems. It wasn't really winning the streaming wars. There was problem in linear TV, growth was slowing down, etc. And they had a different CEO back then. I think it was Bob Chapek. And then, his plan and his execution and his writings are much more different from Bob Iger's, message. And Bob Iger has now come back to Disney, and the things that he writes are, he came in and he just immediately acknowledged all the things that they did wrong, all the mistakes that they had, how they lost their focus on quality and things like that. And that's what you want to hear from the CEO. And it's very hard for most business owners or most CEOs to acknowledge that there are problems in the business. And when they do tell you that to shareholders, they are treating you like part owners in the business. And that's what you really want to see. So just these kind of things, you want good management, of course, as I said, a good moat, and then moats can come in many different ways and things like that. And that's, everybody knows there's, network effects and switching costs and things and stuff like that. But how do you identify them is through financials and this kind of quantitative aspect to it. There's also quality will, of course, stand out. And that's what I said earlier about the annual reports and magazines and things like that. And then just buying them at really cheap prices. So one exercise that I think was really interesting is this exercise that Ted and Todd do, which is that they do not look at the market cap of any company before they're analyzing, and they try to estimate a number for the market cap themselves by looking at how much earnings this company is bringing in and reading annual reports and things like that, and then coming up with the value on that business. And I've tried doing that recently, and I think that I do also end up in the ballpark of the market cap most of the time, plus minus 20%. And when you end up at that ballpark, not only do you improve your valuation scale, but you also, when there's a huge mismatch between your valuation and the price in the market, that's when you know that, okay, there's room to look deep here.
Yeah, definitely agree. Here is where the circle of competence comes, because when you understand that after analyzing the company reports and understanding the business model and their processes, you see that the business can worth much more rather than the market cap on the market right now. Actually, I also usually do this type of thing, and primarily most of the time I try to do the same. So basically I look through the company either from the watch list or maybe different screeners. When you understand, hey, I barely know something about this company, or I heard about this company, or I might be interested in this field as well. And then I go through these process of researching, so understanding about the business, understanding about the management, and then just try to understand after looking through reports how much the company is worth. And basically, when you understand that, hey, it's probably can worth like 150 billion or 500 billion, and now the market cap is almost like 50 billion. Okay, now we are talking. And I also wanted to add here that basically we all know that one of my favorite gurus, and I also I'm the fan of him. You also know Manish Pabrai, and he also always tell that the company cannot be so well, but it can be the good investment, and vice versa. And basically, when we do the value investing, we try to balance between these two things. So basically, at the same time, understand that the business has a great moat, as you said, and has the great economy and has the great management. But at the same time, there's some things with the business which is not fixed yet, and that the market is not appreciated at the same time. But I really agree with you that it is really hard to find this company, because personally I looked through the companies from the prism of the least amount of working capital it needed, because in most cases, and it also the strategy of Buffett and Munger, which you were speaking about. So they're looking at the companies which can scale and with these criteria which you explained, but they do not need additional working capital for that. So you do not need to reinvest in them or add additional points from their profit. And basically you can actually, so for example, like the company has the moat and it receives like 25-30% of the revenue of the net profit. And half of the profit can be taken to the holding company, for example, for the Buffett, and some of the profit can be reinvested. So basically, you do not need external finance for that. And usually, these type of companies have the great leverage, not in terms of the finance, but in terms of the strategy. And also, from my personal way on the philosophy, I also look at the attitude and the management, because in most cases I had these cases when, for example, I analyze the company and it has like 500 million in sales, but the company is barely profitable, so it's like in negative. But the company is like 30 years old and it's with a stable model. They are monopoly on the market. They have the great brands and the portfolio brands. But then I look at the management and I started to listen to them. I understand that the whole compensation and remuneration model is wrong, because they are compensated, for example, for the EBITDA. And basically, they do everything to make the EBITDA profitable and positive. But the company is negative. It has negative cash flow. It has negative profit, and by the P&L statement, it has bad debt and the long-term debt, etc. But the company is great itself. So basically, you are to understand that, hey, as you said, this is the special situation when you need to wait for some time, when the management will be changed, or you just sit and watch what will be next, because in most cases, there are a lot of companies like that. And we're speaking about the investment philosophy and the criteria. And my question here, what are specific sectors or maybe industries and the geographies you are looking right now when you analyze the company? Are there specific ones, or you just industry agnostic and you just look through everything which is interested by you?
Yeah, so I mean that's a great question, and I generally look at mostly companies in the US, and not outside of the US. And I mean, once in a while I do find companies outside of it, but most of my focus is on the US. And then I also try to avoid companies that are very obscure, that are very tiny, illiquid, all those kind of companies, maybe around 50 million in market cap and below. I don't usually look at those companies. And then sometimes the reverse works as well. Companies above 200 billion or some huge number like that, you tend to avoid as well, because you're not going to find bargains at such high levels of market cap. You may sometimes, like maybe Facebook was a couple of years ago, but most of the time there really isn't anything that you're going to know that someone else doesn't already know when looking at these companies. And for specific sectors and industries, I mean, I think I don't really have a specialized knowledge in just one industry or one sector to look at, where I think that this would be like a clear circle of competence. For me, I guess I think I know when I understand a business and when I don't understand it. So rather than a circle of competence, I sometimes have a circle of like incompetence, where there are certain industries and sectors that I just really don't understand, or when I look at them most of the time, I don't get anything out of them. So, sometimes like, industries like pharma, industries in biotech, anything related to with healthcare
Mhm.
mostly, utilities I don't look at because I feel like the regulations are too high for there to be great profits and returns out of it.
Yeah.
And then a lot of financial companies as well, I don't understand. I don't go into fintech and stuff like that a lot because there is a lot of competition in these areas and it heats up and you never know who's going to win the battle. For example, PayPal, very recently, or I think it's for 5 or so years now, the stock price hasn't done too well up until maybe this year or so because of the competition in that space, and then a lot of other fintech players and things like that, and the whole, I find it very hard to understand the whole ecosystem in fintech. I also don't look at banks and insurance companies a lot. I did try a lot to understand insurance and banking and stuff because of course Buffett is Berkshire Hathaway
Yeah.
is a very insurance focused company, and uses that float and reinvests in and stuff like that. But I couldn't find, or I didn't really understand a lot, and I didn't really understand how to analyze or differentiate between those companies. So I don't look at them as well. And then apart from that, mostly even in tech, I generally try to focus on companies where competition is very low. So if it's upcoming tech that everybody's talking about and that seems too futuristic and things like that, but it's profit burning and those kind of things, I don't tend to look at as well because there isn't really there isn't really anything there that I can understand too well. And then there are of course certain industries that are just not favorable in general. So the automobile industry is even if you're Mercedes Benz and even if you're BMW and things like that, they still don't do as well as you would think that
Yeah.
some of these companies would do for the brand that they have. And it is a very value destructive business and industry to be in. And you don't want to be in industries that are, of course, falling and breaking apart as well. So, telecom and all of these linear cable providers and things like that, or these kind of industries where there isn't really a lot that you can get out of it because you want the headwinds. You don't want headwinds, you want tailwinds on your side. And when there are headwinds, then problems will start popping up in any company, in any industry, or no matter how great it is, it will have to face the regional problems that everybody is facing.
Yeah.
And then apart from that, I think that's about it that I narrow it down to. But most of the time when I'm looking at companies, one thing I've noticed is what Buffett says is very true. I think if I look at 10 companies, nine of which I wouldn't really understand. And then there's maybe one that I can say for sure with some level of certainty that I understand the economics of it and I understand that how the business works and how it generates money and how it redeploys capital and what competitors are doing and things like that. So, but I think I tend to understand most companies where they're either consumer facing or even if they're business facing, these companies they're relatively very simple models and things like that. I don't really try to think too deep about some things and take into account every nitty-gritty detail, which I think Charlie Munger also talks about, that you shouldn't be too engrossed in all the specifics and you should be really focused on what generally is going on in the business and
Yeah.
those kind of things.
Totally agree. And I also wanted to add here from Manish Pabrai that basically if you need the spreadsheets in Excel, so it's not your circle of competence in this company. And usually this is so. I also try to follow this rule. And luckily, I can combine the knowledge from the business, from the private businesses and the public equity as well, because having a decade of experience in IT and building companies, it really helps. And I truly understand now the words of Buffett that the further you go in the investing, if you are the better investor, you're a better businessman, and vice versa. And I totally agree with you that out of 9 companies, out of 10 companies actually, so almost 9 or 8, or maybe somehow it depends on the circle of competence, you don't know. And this actually applies to me as well. I try to keep the focus portfolio, and just if I can find 1 or 2 companies per year, it actually the luck. Because in most cases you just see and think and do, I'm not sure, maybe something else, and That's not it. And my question to you in terms of your portfolio, if you can actually speak about that as well. Have you started building it and have you just continuous purchasing the company? So what's your here? Are you more concentrated or how do you work here? Or you just now the preparing for the next steps in terms of the next goals and next track records, I would say.
Yeah, so I do manage some money or my own portfolio. I've tried to get some real experience into value investing and into business and understanding companies and actually buying them with real money, because
Yeah.
I think if you focus with paper money or things like that, then it doesn't really help you control your emotions or doesn't really give you a good gauge of how you perform when real money is involved and real stakes are involved
Yeah.
and I think Munger also talks about it, that of course you should definitely, the only best estimate of how well you do is when you actually start using real money and deploying it and figuring out what goes wrong and what went right, and when you have some skin in the game. And for my own portfolio side, I'm generally, as you said earlier, I think I would consider myself pretty lucky if I found one or three or four or so opportunities in a year. And I usually don't find any for huge time periods. You know, you might not find any for 6 months or for a year or so. And then there are times where you find two or three in a bundle. So, and I run also, I think by that logic, I do try to stay more concentrated, because I think the more you know about the company and the more you are confident about the business and the more information you have and the more certain you are about the future of its earnings and
Yeah.
those kind of things, I think you tend to become more concentrated, because the more, and Buffett also talks about this, that the more knowledge he has, or the more knowledge you would have, the more concentrated the portfolio you would run. And while I do think some level of diversification is necessary, I typically try to stay under 10 or under 5 companies. I usually have under 5 companies or under 10 companies that I'm looking at. And it makes things easier as well, because when you're reevaluating your theses and you're keeping track on them, I think it's much easier when there's a lesser number of companies that you have to work
Yeah.
on. And so in my own portfolio, I guess initially, you know, when I was way back when I was speculating, I think I didn't do as well because I didn't really know and understand the right kind of thing. Now I think it has been much better shaped, and when looking for opportunities, I do try to look as much as of course Pabrai talks about a lot, cloning people, not copying but actually cloning, looking at their stuff on Dataroma and what Buffett's buying or what other Bill Ackman's buying, what Lilu's buying and things like that. And that gives you a good estimate as to, okay, if all of these smart people are buying something similar or they're buying something a lot, then that means that there's probably something interesting for me to look at here. And other super investors as well, looking at all of them, you're picking a couple that you think align best with your strategy and looking at them and then trying to emulate them, trying to figure out why they bought something, why they sold something. I think it works wonders. For my own portfolio, I try and do that. I also try and find ideas from screeners or other sources. Sometimes on Value Line with the free account, I try to find something there, or stockanalysis.com is a great website as well that provides a great screener, and I try to find companies there. But more often than not, I don't find a lot of things. So yeah, I guess that's the game you gotta be.
Yeah, that's really cool. I totally agree with you that it's really rare to find the great thing at a great price, but when it happens, it's the great luck. And I agree with you that the more you know and the more you understand, you have more concentrated portfolio in terms of understanding the company better. And usually in terms of diversification, it still helps because you can actually have under 10 or 5 companies, but inside these companies, you might have the huge portfolio of businesses, like with Berkshire is the same situation here. And I also wanted to ask you a couple of questions in terms of from your book. So basically, it is really fascinating to know that you created the book which you were speaking in the beginning, and it's called The Worldly Wisdom of Value Investors. And we will put the link in the description for those who might be interested to read or listen to it. And my question here is specifically about the book. So what actually inspired you to create this book, and what was the biggest insight for you when you created this actually book and presented it to the audience?
Yeah, that's a really good question, I think. So for the first part of the question, what inspired me to start was the book was that, of course, I was writing blogs 4 or 5 years ago, and through these blogs, my dad posted it on a lot of Facebook groups and things like Facebook and WhatsApp or whatever. He sent it to his friends, and we on Facebook, I mean, a couple of people reached out to us. So Dimitri reached out to me, and then we created this Discord group that now everybody meets on weekly. That I'm sure you're also aware of.
Yeah, yeah.
Yeah, where Brian, Dimitri, Nick, all these people, and very like-minded, value investing oriented people. And so when I was writing my blogs, and I was speaking with them early on, and speaking with you early on as well, and so my dad asked what I should do, and I think it was Dimitri who said I should write my thoughts down, and Brian does that a lot as well. So I started writing my thoughts down, and then everybody encouraged me to then try and write a book. So they thought it would be cool if I wrote a book on what I learned from all these great value investors and what I thought was really, what really worked for them, and trying to understand their models of thought and their principles and how they go about
Yeah.
doing things. And so that basically turned into the book as I started writing and I started compiling a lot of these things. At first, I didn't really think I was going to write a book, but eventually it did end up being a book. And so I think it was a bundle of joy, and I really enjoyed the whole process, and I got to learn a lot. And probably the greatest insight I got, of course, I got a lot of value investing related insights, and it really just helped me boost my journey in value investing. But I think the most important lesson I learned from this whole process was that if you try and pick out a couple of mentors in a field and you try and observe them and learn from them and try to understand how they think, then I think you grow a lot in that field and you rise a lot faster in that field than if you try and work everything up by yourself. And this is something William Green also talked with me about. And William Green is the author of Richer, Wiser, Happier. And I think,
Yeah.
of course, a lot of your podcast viewers would know. And he told me this as well. And so now I keep a document where I try and list down mentors, and I list down certain people that I do admire and I do think are great people in their own fields. It doesn't have to be all investing or all business, and it can be a wide range of fields. In fact, I think it is better if it's a wider range of fields, as Munger says, because then you get to adopt more mental models and more ways of thinking and understanding. So, people from sciences, people from business, people from investing, even people from economics, statistics, politics, or any aspect that where you can find great leaders or great people in what they do, and you try and list them down and you try and compile, one or two things that you learn from each one of them, or that you think is the most admirable in each one of them, and or you go about and you study them very deeply. And I think once you do that, I think that is probably the most quick way to build a huge knowledge base, or probably the fastest way to get really good at doing a lot of things. And I think, and I hope to continue to be able to do that and get to their level. Of course, that's an incredibly challenging goal, but I think for everyone, if they tried to do such a thing, it would work wonders.
Yeah, that's really amazing. And I agree with you about the concept of mental models. It's one of the greatest insight I've received for after some years from Buffett and Munger and other investors. So basically, when you just try to understand their thoughts and model processes and understand how they think and how they analyze everything and make the decision, take the decisions, and actually using your book to understand the information from different investors, you can change your life for the better, because applying these rules in not only the investing and finance, it actually can be the business, the life, the sport, the social life, anyway. So basically, these are basic concepts which might help you to change the life for the better. And I also wanted to add here that it's really great because the investing is the broadest discipline. It covers everything. So basically, the more you know, the better for you, and you enlarge your experience and expertise in every field, no matter where you proceeding and moving forward. And my question to you right now, in terms of the understanding in finance in general. So are you planning to utilize this knowledge because you receive this a lot of information about the company's businesses for your life in terms of like part of your life and then just pursue something else? So it's just using this as a tool, or are you planning to make it like the whole life and being in the finance and investing? So my question more about your strategy here. So what are your plans in terms of that? Are you pursuing like the degree in finance and investing, or are you planning to be the investor, like the professional investor, or using just the parts of these rules in your life?
Yeah, so I don't know right now where I want to go, but I definitely enjoy value investing a lot, and I do enjoy this whole discipline in general. And so I think I might probably be leaning towards it, and maybe in the future I may end up pursuing something related to investing or finance or business or in that domain. But at this point, I don't know, I'm not sure. It's my hobby and I do really enjoy it. But I also want to learn as much about the world as possible. So I do want to make sure that, as Munger says, that I do have an interdisciplinary focus on learning. And of course, you can find that outside of classrooms and outside of a degree as well.
Yeah.
But yeah, so far I don't have any plan on what I want to do or where I want to go, even though, of course, I'm very interested in this field and
Yeah.
I might lean on this part for
Yeah, that's actually fantastic. But anyway, no matter what you choose, I think that it will give you the tremendous advantage because you will receive the broader knowledge and understanding how the big businesses, the corporations, and other investors and the finance work in general. And it can be utilized in any field. And this is a really great advantage when you receive it earlier in the beginning of your career, of the path, when you just understand and try to figure out where to go. And one of my final question is, what would be your pieces of advice for those people who are interested in finance, like or investing like you right now, or maybe just want to start, maybe learning something about this field and understanding more about the companies? What would you recommend to those people? Maybe some books to start with, maybe some courses, learning resources, maybe websites, or any other sources of information, or maybe any other steps.
Yeah, so I think the way I went and I did it was, I think of course, there's a huge chunk of resources out there, so knowing what to pick is really important and what to pick at the right time. So, for example, I very early on I tried reading Buffett's essays and Munger's book for Charlie's Almanac and those kind of resources, and security analysis or intelligent investor. But I think when you're new to that domain or when you're just learning something, to dive right into probably the most complex text is not the right thing to do. And I would say I didn't understand anything back then. And then now, when you come back to it, then you actually, oh wow, this is what he actually meant, or you actually learn something from it. In terms of books, I think Bruce Greenwald has some great books. He's part of the Columbia Value Investing School, so in Columbia, the Columbia Business School, and he talks a lot about different value investing styles. And I think his book gives a very good introduction into value investing and all the different frames of value investing and how it actually works and the idea behind it. I think also One Upon Wall Street is pretty good as well. It's a bit, it might be a bit dry for some people, but I think it's a good book to start with because it's really easy. He doesn't talk about anything too complicated. And if I can understand it, then I'm sure a lot of people can understand it as well. Of course, a lot of people much older than me will grasp it way better. And then the next book I went to was Joel Greenblatt with the Little Book That Beats the Market. I think that was a great book to begin with as well. Regarding resources, I think if you listen to Pabrai, if you listen to Charlie, if you listen to Buffett and their talks from their AGMs, or you listen to, let's say, Guy Spear, or all these kind of people, I think you get a very good idea and a sensing as to how they think and how they analyze businesses as well. I think Pabrai also sometimes talks a lot about his investments, and he tries to give at least some insight or some knowledge as to what made him go about in doing that investment and how he thinks about businesses, or he gives a lot of case studies and things like that. So yeah, and I think case studies is also a wonderful thing to looking at different businesses, why they succeeded, different businesses that different investors owned in the past, and then what made them own it. Did it work out? Did it not work out? Why Buffett and Munger, for example, bought See's Candy, or why they ended up doing some decisions, or some decisions that backfired, why the actual Berkshire Hathaway
Yeah.
mill decision didn't work out for him, and all those things. I also recommend, I guess, the Manual of Investing. I think that's what it's called, MOI Global. I think that's a great place to get a lot of resources. And in general, just reading a bunch of these things is really good. Maybe my book as well. But so yeah, so a lot of these books, I would say probably the best way to go about is to go straight into books or podcasts, or to listen directly from the source. I think going into courses or reading blogs and stuff, it may work out, but a lot of people out there claim to be value investors are actually not value investors, and you may end up being prone to speculation or
Yeah.
or other kinds of things. For example, following people on Twitter or Reddit is probably not the best idea for
Yeah.
now, before you don't realize who actually are great investors in those fields. William Green has also a great book, and then I think Bogomil Baranowski has a good podcast as well, and then Robert Karras. A lot of these different people have really fantastic resources that I think are worth looking at, yeah, and learning from.
Yeah, that's fantastic. And I'm sure your book will be also valuable for the audience and listeners, and they can find a lot of insights there as well. We will put the links for all books and resources which we were speaking about in the description of this podcast or video, wherever you listen or watching us. And I hope they might be useful for you as well. And any final words to our watchers or listeners, Herday?
Yeah, just keep learning and keep growing, I guess. Yeah.
Yeah. Thank you so much. It was a really valuable conversation with a lot of insight, and I hope it will be, and I'm sure it will be useful for our listeners and audience as well. Thank you for your time. And if you guys have any information, ideas, comments, please leave them in the sections below, and we will try to answer them and provide different resources. And thank you one more time, and see you next time.